just to start off, a reminder about YPM Capital. Really, the proposition's built around our long-term track record. We like to highlight, the total return since inception, because really we're in the game of accumulating capital over the longer term, all built on the integrity and consistency of our philosophy and process. Very important, 30 plus years, same philosophy, same process. We think we're one of the few managers that can really highlight that attribute. Importantly, if you look at our portfolios, very simple ideas, simple businesses, and we play those ideas in a number of different ways. Also, very much aligned with the investor. We think our alignment is at the very highest level. PGF, we own 8.4% of the company. PAF through PGF, 24%. And really just to highlight that, we are genuine long-term investors. We're not fund gatherers. In other words, external processes are not going to corrupt our process. And it is also your basic minority protection, because we're the largest shareholders in both of the funds. In terms of why PGF, the original proposition, facilitate the offshore investment proposition, better breadth of opportunity, better risk reward. I said 2 years ago that I think this is the sort of scenario that you'll probably see for the next 10 years. And if I sit here today, that is very much in place. You'll always have a better breadth, but we still see better risk reward offshore. And more importantly, most investors are still 90% plus invested in Australia. They just don't have the diversification that they should. So this is a way to facilitate that. If you look at our portfolio, it is very much a stock picker's portfolio, selective and concentrated positions. So it's a very different risk reward proposition to the market, and that's something I want to highlight, and I'll go through a couple of charts to really bring that out. Importantly, we think we do have a collection of businesses that are discounted to their inherent worth and will provide attractive opportunities, and you're able to get them at a further discount by PGF, which currently is about 15% for PGF and PAF about 10%. But importantly, if you actually look at the NTA versus the share price, flip it around, it's actually a 20% increment to get back to NTA, and it just shows the sort of free kick you can get if you're going to be there for the longer term. Dividend yield, we're now paying a dividend yield for both companies. PGF's a bit over 5%. PAF on an annualised basis, they haven't paid their second year dividend yet, but that's about 7.5%. And people often ask about buybacks. Well, if you go back to our own holdings, which we've increased in PGF from 3 to 8% over the last 2 years, it's a quasi buyback because we're shrinking the external float. So we are in fact doing it. The only difference is I'm keeping the discount to myself effectively. So bottom line is, if you think about investing, the basic objective is to buy assets at a discount to their inherent worth and sell assets that are selling at a premium to their inherent worth. And so here's a classic opportunity, particularly when you look at the Australian framework. A lot of the big ASX LICs are selling at a premium to their net assets. We're selling at a discount. So we would argue it's a pretty simple arbitrage longer term. In terms of the portfolio investments, you can see here, this is typical of our portfolio. They probably have 6 to 8 core investment themes that really dominate. But importantly, they're all genuine long-term opportunities. As I said, very simple ideas, simple businesses. So you can see there with Broome, we started back in 2003. The post-GFC housing crisis, 2009, started in Las Vegas, went to Ireland and Spain. Domestic banking, 2009, the CBA equivalents, focusing on yield. Google, Visa, Chicago, first started back in 2011. And then if you look at our most recent investments, Macau and our alternative investment managers, 2015, but we expect to hold them for quite some time, and I would expect at least a 3 to 5 year minimum holding period. So it's that repetition of the same type of opportunities. Basically, we just go out there and find opportunities that meet criteria. That's really what we're all about. In terms of the markets, obviously, short term, we continue to go through this, paranoia about the sustainability of economic growth. It started back in 2009. We said it's going to be 2 steps forward, 1 step back. The 1 step back is every time you have a mini crisis, Greece, Cyprus, the Euro crisis. At the beginning of this year, it was China and oil. Then we've had Brexit. So it's just this sort of rolling paranoia about the economy. It's just something you're going to have to get used to. But, I kind of highlight it as a climbing the wall of worry. We all know that negative interest rates don't work, low rates don't work. The authorities have finally worked that out, so you're starting to see noise about fiscal and productivity issues, etc. So I actually see that as a big positive, and I actually think that going forward, 2017, we actually might get a surprise on inflation and growth. And if you look at the way the markets are behaving, and the best way to do that is to look at the chart on JP Morgan. What it shows here is that at the beginning of the year, you had the big growth scare, financials sold off. My instincts tell me that dichotomy between defensive and the more cyclical valuations that reached an extreme back in February, I think that was the extreme. And the markets have basically been in a process this year of starting to rotate. Brexit created a bit of an interruption. So you can see with JP Morgan, the stock recovered almost back to its highs as the earnings were fine, the US economy was fine. Then we had Brexit, knee-jerk reaction, sell off quite aggressively. But what you found is that the more they were removed from the UK, the quicker they came back. And JP Morgan is now selling above pre-Brexit levels. They're just focused on domestic issues. If you look at ING, which is a similar story, but in Europe, it's at pre-Brexit levels. So it's recovered, but it's still, people are a little bit more worried about Europe than they are the US. So you've still got that recovery to come through. And then obviously the UK-centric is still selling, above their lows, but, pretty close to where they were. It's going to take 12 months for the market to be really sure about what's going on in the UK. But bottom line, the fundamentals continue to come through. But the real point I want to make is that rotation, defensive cycle, I think it's already going on. And I think when you look back in 3 years' time, you'll realise that 2016 was actually the bottom in long-term interest rates. And what that means is you're going to have a very different subset of opportunities that you need to be playing going forward. Very quickly, in terms of what's been going on, the strong earnings growth, the monopoly positions, the exchanges, Visa, have just continued to march on as earnings have come through. No change there. But as I mentioned, I think we are seeing an inflection point in rates. So what we've got here is Simon Property Group, one of the bigger REITs in the US, and the 10-year bond. And what you'll see is that earlier in the third quarter, Simon Property began to sell off on the back up in those long-term rates. Now, it doesn't look like a lot, but my instincts again tell me that this is the first sort of move. And now you want to be on the short side of anything that's related to long-term bond rates. We actually shorted Simon Property Group and a few other REITs. We actually closed it out because it's came down so quickly, but we're looking to re-establish those positions. Over the next 3 to 5 years, we want to be short bond proxies. And again, to highlight the importance of what I'm saying about that sort of rotation that I think is just starting to occur, don't underestimate how big a move we've had in rates and the fact that it really is abnormal to have zero rates. The financial plumbing does not work with zero rates or negative rates. And as I said, I think we're more likely to get a growth surprise than an inflation surprise next year. So when we look at the market, our outlook for the market is pretty subdued. S&P is pretty close to its heights. But within that, you've pretty much got the dichotomy, and we think we're going to reverse that over the next 5 years. So again, you don't want to be buying the market. You only want to be buying opportunities that are going to give you an attractive return. So that kind of brings me back to our latest two investments, which I mentioned, the alternatives and Macau. And what you can see here is clearly they're a different proposition to the market. Market's at its highs. Both these are off 60 to 80% if we go back to the earlier part of the year from their highs. Now, you might think that an alternative investment manager in the US is going to be very, very different to a casino in Macau. And yet short term, the dynamics are very similar. And it's just coincidental that they've both gone through a reported earnings downturn. In the case of the alternatives, it's their performance fees. Reported performance fees collapsed. But the interesting thing about the alternatives, performance fees come in, they're kind of lumpy, and they sold all their investments back in 2015, and now they're redeploying for the future. But the inherent earnings power of the alternatives continues to go up because they're receiving lots of flows. Basically, in the US, you're seeing money go out of the traditional managers because everyone realises they're just copying the index, and they're going into either index funds or alternatives that are genuinely trying to produce alpha for them. So their flows are continuing. They're run by the sharpest guys on Wall Street. And the interesting thing is they were selling on single-digit PEs, double-digit dividend yields, much cheaper than the traditional guys, which were under a lot of pressure. And to be honest, through the course of this year, we were scratching our head as to what was going on. But again, the final sell-off caught up with China and the oil scare back in February. But since then, the performance fees have started to slowly increase. People are starting to slowly be attracted to the story. But again, we expect to own this for 3 to 5 years. You can see it's a very different proposition to the market. And then Macau's the same. Classic casino, went through a boom, brought on all the capital expenditure. Just as the crackdown on China came through in terms of corruption, revenues collapsed, earnings went south. So people obviously sold down the stocks. But the reality is we're now at the end of that capital expenditure and we're seeing an inflection point in gross gaming revenue. So the market, again, very volatile the early part of the year, but now these stocks have all rallied off their lows and people are starting to realise that we have reached an inflection point. So that is those two stories are typical of what we try to do. If you go back to the brewing in 2003 or the banks in 2009, exactly the same type of story. So just a reminder, the portfolio is a very different proposition to the market. We think they're discounted to their true inherent worth, and better off, you get a further discount by coming in through the listed vehicles. So that's the quick summary